It was a tough day in the U.S. stock market with the S&P 500 down about 0.8%. This, of course, ended the 8-day rally that we had previous to today for the S&P 500. Today's culprit was rising interest rates yet again. It seemed to throw a cold, wet blanket on top of what had been a red-hot rally. But we did notice that there were some areas of the market that withstood the pressure a little bit better, including the insurance stocks, including some of the mega cap areas that ended up with what we would refer to as bullish intermediate confirmation signals that I'll explain in tonight's video. But the small caps really struggled here today and look like they're continuing their bearish trends from before. We're also going to get into a lot of international evaluation in tonight's video. We're going to talk about countries like Poland and countries like Brazil in terms of outperforming their international competitors from an equity perspective. We'll also talk about the commodity markets, where we recognize that some of the soft commodities like sugar are really outperforming the metals and the energy commodities. We'll then get into our trade application example, where I wanted to feature a transportation-related play to play bearishly to kind of follow up on our Comcast trade that worked perfectly a couple of days ago. I'll show you in tonight's video how to do a bear call spread where we'll be in the trade for a little bit longer of time, but comes with some key benefits, including defined risk. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 9th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. You'll also see which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and repost on that Market Outlook related commentary. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And it was a bit of a sour end to our winning streak. The S&P 500 had been up 8 days in a row, and had they somehow squeaked out a victory today, it would have been the best win streak since, I think they said, like 19 years or something. So narrowly missed that, but nonetheless, it was a good run. We certainly were overdue for a bit of buoyancy in the market. But like all things, things got to come to an end at some point, right? You can't just have a streak go on forever. So today was the end of the party, and in some regards, it got pretty ugly, right? We're looking at the heat map here. You can see some pretty bright red squares out there. My attention is focused here in the upper right-hand corner, where a lot of those well-known healthcare stocks just got stomped today. Worst performing stock in the S&P 500 today was actually the Becton Dickinson, ticker symbol BDX, and it was down 9%. So that was a pretty ugly day for what is traditionally a pretty quiet stock. That's a dividend aristocrat that usually doesn't come with a whole lot of controversy, but it got hit pretty hard today, as did a lot of its competitors. Once again, the whole weight loss drug controversy is creeping into the healthcare system and doing some pretty intense damage. Interestingly enough, today was a day where the weight loss drug provider itself, Eli Lilly, also got hit, right? We saw plenty of those days across the summer and fall where Eli Lilly was up and then most everything else in the healthcare world was down. But today, even they got roughed up. Part of that, by the way, is I think AstraZeneca over in United Kingdom is planning on a competitive weight loss drug to compete against Eli Lilly and Novo Nordisk. So that might have shaken a little bit of fear into the system. By the way, I could go over here real quick to the world heat map, And you can see that AstraZeneca right here was actually up today. So not up huge, but nonetheless being able to avoid the fairly large sell-off that we experienced here in the United States. So I do wonder if that was part of the reason that Eli Lilly struggled a bit here today. They've had some good news this week in regards of getting the actual approval for the weight loss side of it. It had been on the diabetes side, but I think that was largely baked into the share price, as that has been one of the strongest performing stocks in the entire year. But notice that a lot of other healthcare companies, sorry about that. I'm trying to get this little advertisement off of here, but apparently that is stuck on there. So this is coming from FinViz's website, so it's not on the Thinkorswim platform, so we got to put up with that advertising. But anyway, a lot of these healthcare companies getting hit pretty hard today. AbbVie down another 3%. Pfizer has been just demolished. It's trading below $30 per share now. Completely round-tripping any benefit that it had from being, one of the vaccine manufacturers from one of the worst global health pandemics that we've had to deal with in our generation. Yet that was basically all for nothing, according to the stock market. You can also see that Amgen was down over 3%. Bristol Myers was down nearly 4%. Gilead was down nearly 4%. I mean, these are some massive moves. Remember, these are not small companies. In many of the cases, they're $100 billion plus companies that were just witnessing random 3 and 4% complete, wipeouts for, no good real reason. That, in other words, not a whole lot of individual stock news with some of those. So today was just a real ugly day there in the healthcare world. Remember, when I was with you on Tuesday, we had looked at the sector selector, and healthcare was either at the bottom or near the bottom. I couldn't remember if it was second to last or last, but there was already some problems there within the healthcare area. And again, a lot of this is the market trying to sort out what do these weight loss drugs mean for the rest of the healthcare stock world. Generally speaking, I think the mindset is that the weight loss drugs are good for society and will maybe help keep certain portions of our population healthier than they would have been otherwise. And that's a great thing for the world in general. But as capitalists, where we are looking at stocks and trying to judge what their future profitability will be, many of those companies that at this moment, in one way or another, either directly or indirectly, benefit from obesity and the knockoff effects that happen from that, whether it's joint pains or CPAP machines or whatever it is. There's a whole bunch of things that could happen. If the world suddenly becomes slimmer, many of these things may not have the profitability in the future that they have witnessed in the past. So market is struggling through that here at the moment. So that really caught my eye. Healthcare really getting trounced here today. They weren't alone. There were other areas that struggled today. As you can see, plenty of red on the board. Utilities struggled once again, and there's the big boy, the NextEra Energy that we've talked about so often here in the last couple of months. Remember, it remains the largest utility company in the United States, and it is the one that seems to have had the most volatility here recently as well, both on the downside and then back on the upside here the last couple of weeks. It had been rocketing back higher, and now it's the last couple of days falling over yet again. So that one's been interesting to watch, but they're certainly not alone. Most of the utilities were lower today, just not quite as much as that one. So that's going to have a big impact on the market cap weighted utility ETF of XLU, I have no doubt. There were some discretionary stocks that really struggled today as well. Home Depot generally does not move 3% in a session for no good reason. Lowe's didn't fare all that much better, down 2%. Starbucks was down 2% today. Nike was down 2%. I mean, these are some of the heavy hitters there within the consumer discretionary space. A lot of the regional banks struggled today. Excuse me. There's Truist Financial down 4% as just one example. But they certainly weren't alone. The vast majority of regional banks on the outs here today as well. In terms of the Magnificent Seven, mostly a down day for them as well, but I would say they probably, all else being equal, held up maybe just a touch better than the market more broadly. You can see the big giants within the technology sector Microsoft and Apple both were down slightly less than the market at large. The S&P 500 was down about 0.8% today. So Microsoft down 0.7%, Apple down 0.26%. They both fared slightly better than the market. NVIDIA actually easily beat the market, not just in a relative sense, but actually in an absolute sense. They were up 0.81% today, so that was probably the most impressive of the Magnificent Seven today. In the communications world, we had Alphabet down over 1%, so they underperformed the market, but somewhat offsetting that, Facebook was actually up a little bit today, or Meta, up 0.24%, so a bit of balancing out between those two. And then down below in the consumer discretionary area, this seemed to be the area that took it across the chin the most from a Magnificent Seven perspective today. Amazon down over 1%, and then Tesla really getting roughed up, down 5.5% today. So kind of a mixed bag there, I would say, in the Magnificent Seven. Remember, earlier this week, they had been outperforming pretty obviously. Last week was the opposite, where it seemed like the rest of the market did better than the Magnificent Seven. Early this week, it's been Magnificent Seven doing better than the rest of the market. Today kind of felt like it was about even. It seemed like everything was kind of getting touched up a little bit there as we ended our win streak across the entire S&P 500. In terms of patches of green, there's not a whole lot out there to report in terms of consistency. You could maybe get away with saying some of the health insurers did a little bit better. Notice that Humana was up, Centene was up, and Molina Healthcare was up. Even United Healthcare was up. But it wasn't a clean sweep there either. Cigna was down, as an example. But, again, that's kind of being impacted by the whole weight loss drug controversy and how market participants are thinking about that. And if, a lot of people are going to be losing 25% of their body fat and will no longer have as many health conditions in the future, yet the health insurance companies can still get away with hiking premiums. I know in my case, we got our bill the other day, and looks like our healthcare bill is going to be going up about 20% next year, and I'm sure that's probably the case for many of you as well. Not very fun to witness that, as it seems like, in this high inflationary world, it's easy to point fingers at the oil companies and how much we're paying for gas and all this kind of stuff. But I mean, if you look at it behind the scenes, the health insurance companies have been absolutely gouging us for years. And this seems to have no stop in sight with it. So anyway, if those that are paying for health insurance are getting healthier as a result of these weight loss drugs, and they are not as much of a tax on the overall healthcare system, yet the health insurance companies themselves can continue to raise premiums, that's the sweet spot, right? They're making more money and having to cover less costs if that plays out the way that it does. Obviously, just speculation at this moment, but maybe that was the reason that those health insurance companies were able to be mostly in the green today on a day when the rest of healthcare got absolutely demolished. Other areas of green, I would say insurance catches my eye. Been talking a lot about insurance companies in my top-down trend trading class here more recently. You can see many of those up today. Aon, MMC, AJG, WTW, Bro, they were all up here today. You can also see Progressive was up over 1% today. Travelers was up a touch. And Lowe's, not the home improvement company. There's a separate company called Lowe's, ticker symbol L, that's also in the insurance space. It was up about 0.5% today. Of course, the big kahuna of them all, Berkshire Hathaway, in the insurance space there, up 0.5%. AIG was up nicely today. The Hartford was up. So seems like that's a bit of a theme. And then I would also point out that some of the exchanges did pretty well. And so some of you that have been attending my classes lately, we've been kind of breaking down the financial sector, and that's the exact thing that I was talking about a couple of weeks ago, in that, in the financials world, we kind of have a lot of the haves and have-nots mentality right now. and the haves are the insurance companies and the stock exchanges. And once again, that reared its head today to prove out that point at the exact same time when the banks were getting trounced, right? Most of the major banks down over 1%, the regionals down even worse than that. And of course, the investment banks, Morgan Stanley, Goldman Sachs, they have not fared much better. So financials have been interesting in that regard here more recently. But other than that, I can't really see a whole lot of trends. I should point out Disney just because it's a very popular company in the Dow Jones Industrial Average and all of that. And seems like more times than not in recent years, after they've reported earnings, their stock has been gutted. Today was the opposite. Finally had their day in the sun. And Disney was one of the leading stocks in the entire market today, up about 7%. So kudos to the House of Mouse. All right, let's go ahead and pop on over and take a look at the actual breadth numbers now on a one-day basis. Remember, this does not tell us anything about breadth over multiple weeks or months, but on a one-day basis, today's breadth was pretty terrible. And you can see 125 stocks out of 500 stocks closed in the green today. That was not very broad participation. That's where the term breadth comes from, is how broad was the activity, either bullishly or bearishly. And today, not very good breadth, as very few participants were carrying this market where it could. That's only 25% of the market that closed in the green today, meaning that 3/4 of the market was in the red and spoiling the party that was otherwise going to be the best win streak in 19 years. So when it came to a halt, it came to a big halt. And now looking at the charts here, remember when I was with you on Tuesday, it would have been that candle that I'm circling right there on the S&P 500 chart. And remember my discussion at that time was we had such an epic rip higher in the market after that back-to-back oversold cluster signal that had occurred for the first time in a year on the S&P 500. But on that candle, when I was with you on Tuesday, I said, watch out for this area back here in the middle of October, because that looks to be an obvious point of where the market might make the excuse that it wants to stall out. This was, a parabolic type of a move in a very short amount of time, and that can't last forever. So now we are seeing that after you were gathering so much momentum day after day after day at aggressive rates. Remember, I think 4 out of those 5 days we were up over 1%. So these were not just, throwaway nothing days. These were big days to the upside. But this week has been the opposite. Yes, the market continued to grind higher for about 3 more days in a row right there, but those were throwaway days. Those were afterthought types of moves higher where the market was just up by the slimmest of margins. And yes, technically they were up days, but with any amount of new information, you could have easily had a down day on any of those 3. Well, today we did get the down day, and look at how aggressive today's candle was. It engulfed 3 of those candles. So in other words, this was Monday, this was Tuesday, this was Wednesday, this is Thursday, and today, Thursday's candle engulfed the full week already from a bearish perspective. And remember, that's part of the reason I did the bearish trade on Comcast with you guys on Tuesday's video. Remember, that was the trade application example, and I was talking about how I had mostly had bullish trades in our portfolio up until that point because we were doing bullish trades when the market was getting oversold here in preparation for a market bounce. And likewise, after we had a major epic market bounce, I was willing to do a bearish trade right here, which was only the second bearish trade in the portfolio. And guess what? Comcast hit our target price today. We're out of it already. So that happened very quickly. Here's what the chart of Comcast looks like. But we got in right there, and 2 straight days to the downside, we were out today at $40.85. So right around where it closed. But the point is, we were able to have a very, very quick win with our trade application example, with the acknowledgement that this move in the overall market seemed to be running on fumes as it was stalling out in that area, and had a decent chance of having a little bit of selling pressure as a result of this prior resistance area over here in October. So I'm glad to see that one worked, because obviously I never know in advance which trades will work and which ones won't, but in that particular case, it was nice to see that the technical analysis that we use assisted us in a nice winning opportunity there with the short sale on Comcast. So anyway, a pretty ugly looking candle today out of the market. We were only down 0.81%, so we don't want to make too much out of it. It's not like a disastrous type of day. It was more disastrous in certain areas like healthcare, but for the overall market, it wasn't the end of the world. We've seen worse days than this plenty of times. This was not even one of those days where we were down 1%, where I would have normally been doing a sold put trade, right? We got close to it, but not quite there. So today will not be one of those sold put days. I have another trade idea in store for you at the end of tonight's video. So it wasn't the biggest type of a pullback that you'll ever experience, but just looking at it, eyeballing it visually here, and acknowledging the bearish engulfing dynamic of this, where basically you eliminated 3 days of bullishness in one fell swoop, where it looked like we had a chance in the morning to have a 19-year record in terms of our win streak, where there was optimism in the morning that quickly turned to pessimism by the end of the day. And when this candle is filled in red the way that it is, it basically means you started high, you ended low. And that has some damaging effects on investor and trader psychology there as well. So not necessarily the best of looks. Another thing I was going to mention is here after hours tonight on Thursday, there have been some stocks that have been just absolutely blasted here tonight. Some of you might have seen me tweeting about, I think, at least one of them. I'll show you what I mean. I always get a kick out of this photo right here, but you can see the guy's looking at his trading screen there, and the joke of the photo is that the candle is just collapsing so aggressively it's literally shooting down below the desk. And I thought that was quite apropos with the stock in question here today. Oliver had mentioned that the trade desk, that's the name of this company, just got obliterated, and he was right. This stock is just getting destroyed in the after hours session. So seeing the lasers shooting through the desk on a company called the Trade Desk seemed like a good fit for that particular meme there. But let me show you some of these after hours movers tonight that's not necessarily helping the mood at all here tonight. So let me show you the Trade Desk first. Here's ticker symbol TTD. This is an online advertising platform company that became quite popular, a couple of years ago, especially immediately after the COVID crisis. So it had a tremendous run of things a couple of years ago, one of the better growth stocks out there, but it's been getting demolished here more recently. As you can see, it closed today's session at about $77, but look at where it's trading after hours, after it reported its earnings. It's trading down below 55. So in other words, you're losing over $20 per share on a $77 stock after hours here. So that one is going to be ugly tomorrow in all likelihood. And they're not alone. There were other massive movers after hours tonight, mostly to the downside. Here's another one, Illumina. This is a very popular growth stock from probably about 10 or 15 years ago. Many of you may know it with some of the healthcare DNA tests and things like that they run. But anyway, this stock has been demolished here in the last year or two as well. 52-week high on it, $248. It ended today's session at $107. And the pain is just getting started, apparently, because after hours they reported their earnings and their stock is down about $10 per share. You can see it's last traded here just a hair below $98. And so that stock is down, whatever it is, 10% or whatever. And this is one that's in the S&P 500, so could have an impact on trading tomorrow. That's another healthcare related company, right? So we might have more red on the screen from healthcare's perspective tomorrow for all I know. So that one's getting roughed up. Another one that I noticed is getting roughed up after hours tonight, Arista Networks. This was a stock that had become quite popular back in the winter and into spring earlier this year, around the hype around AI. And this one had actually been quite close to a 52-week high. You'll notice that it ended today's session at 211, which was actually up on the day, on a day when the market was down. So it looked pretty promising. And its 52-week high is 216. So it really wasn't that far away from a 52-week high here today. But after hours, things are looking a little bit less ideal. You can see the stock is trading just a little bit below $200. The bid is $198, the ask is $200, so it's down about $11 per share after hours. Another one that was down after hours was Unity Software. This was another one of those kind of, recent growth IPOs from a couple of years ago when everybody was, giddy with their stimulus checks and just pumping money into these kind of, growth stories that are out there. Anyway, Unity closed today's session at $25.24, and it's currently trading below $22 in the after-hours session. So there's another one that's getting roughed up. Here's another one. If you enjoy going to Vegas like I do, you'll certainly recognize Wynn. Of course, they have some locations around the world as well, including over in Macau, which I've been to, and is also a very nice facility. Anyway, what's not so nice is how their stock is trading after hours tonight. Wynn closed the session at about $90.65. They're trading closer to $85 in the after-hours session, so there's another $5 per share haircut on an earnings announcement. And then a couple more speculative ones, but down aggressively from a percentage basis. Groupon, which was probably a growth stock, 10, 15 years ago or something like that as well. It's kind of been a forgotten about stock here more recently, and quite frankly, I didn't even realize it was still trading until I saw it flashing across my various screens of after-hours movers. And you can see here, Groupon ended the session today at $13.50 and is trading closer to $8.50 after hours. Now, that doesn't sound like a lot, perhaps, but remember, $5 per share loss on a $13 stock is an absolute massacre. And that is what is happening to Groupon shareholders after hours tonight. And then one more speculative one, Plug Power, ended the day at $5.93. Right now, it's trading at $4.30. Again, that probably doesn't sound like a lot, but on a percentage basis, that is an annihilation that's taking place right there. So that definitely caught my attention here today. It felt like we had a lot more after-hours movers that were absolute disasters, and very few that were offsetting that to the upside, right? A lot of times when we have this kind of portion of the presentation, I show you both winners and losers. This was overwhelmingly a losing batch, and not just by a little bit, but by a tremendous amount. So that probably doesn't help the sentiment heading into tomorrow morning either. Let's get back to our traditional charts here once again and kind of wrap up this discussion. So the S&P 500 was down 0.81% today. Bearish engulfing candle engulfed the last 3 days and ended the 8-day win streak. We remain with a strongly bullish intermediate posture. Notice the intermediate line, this green line down below, is still in the upper reversal zone despite today's sell-off. And we are still above a rising 30-day moving average, which is why that 30-day moving average color is green at the moment. So yes, today was a tough day, but it's not that all hope is lost. We still have an opportunity to kind of save this rally in the coming days, so we'll keep our eye on that. With the Dow Jones, oh, and by the way, I should also point out that we had bullish intermediate confirmation signals across a lot of these indices today. Remember, that occurs when you have a bullish posture on the green intermediate line on the same day when the red momentum line is in the lower reversal zone. Now, in addition to that, we like to look at where the blue line is on those days to see if there's a healthy enough pullback, and the blue line is actually in a pretty good spot for this at 43. We usually like to see that blue line between 20 and 50, and then we also want to double check the red line to make sure it's not below 5, because that would otherwise be too of an extreme of a sell-off. And right now the red line is at 6. So this is actually a pretty good example right here of a decent bullish intermediate confirmation setup here on the S&P 500. You'll notice the same thing is happening over here on the Dow Jones, green line in the upper reversal zone, red line lower reversal zone, blue line between 20 and 50, red line a hair above 5 at 8 at the moment, and then the NASDAQ composite is the same way. Notice that the green momentum line is in the upper reversal zone, so it's still bullish. The momentum line, short-term oversold in the lower reversal zone, but still slightly above 5. It's at 5.89, so that one was a little closer, but still would kind of qualify under that quick check. And then the blue line is between 20 and 50 here as well, just barely, right? The blue line's at 47. But that I thought was kind of unique as well, because remember, a lot of times when I show you guys these bullish intermediate confirmation signals, it's kind of like, well, you know, the signal's there, but here's the negative aspect of the signal. With these ones, it's actually pretty good examples. And so maybe that is helpful for our forward look here in the immediate future as well. For those of you that are newer to the video, the way you can think about the bullish intermediate confirmation signals is they're effectively buy the dip signals, right? It's acknowledging that the intermediate trend is still bullish, which is what the green line is telling us, and then trying to buy the dip within an uptrend, right? And in order to buy the dip, we're waiting for a pullback, and that red line helps us identify if we have a decent enough pullback, which today would have been identified as such. Doesn't mean that we can't go down more or that this signal is guaranteed to work out or anything like that, right? Nothing is perfect in this world, but for those of you that enjoy that concept of buy the dip within a continued uptrend, then you know these have some decent setups here today for that. The Russell 2000 does not have that, by the way, and the reason is you can see the green line has rolled over. So notice on the Russell 2000, we now have a pink background color on the chart. That's identifying that the green intermediate line is no longer going higher. So that basically nullifies the bullish intermediate confirmation signal there, because the intermediate line is not bullish. Here it is bearish. And therefore, despite the fact that the red line is in the lower reversal zone, it no longer matters, because now you're not buying the dip of a continued uptrend. Here, this is basically showing us that it's a continuation of a downtrend, if anything else, right? This chart on the Russell 2000 does not look particularly good. In fact, it looks like it's primed for bearish trades, if anything else, right? That is, it gave you an attempt here a week or so ago, and it looked like it wanted to be ambitious about getting above that moving average, but that was short-lived. And notice how we are clearly struggling to stay above that moving average. The other three indices were still good to go. In fact, we still got air pockets, nice air pockets between the candle today and where the 30-day moving average is. But the Russell 2000 looks completely different. Here it looks like the selling pressure is just too heavy for this chart, and it cannot get out of its own way right now. So we're back to weekly bearish posture on the Russell 2000, and the 30-day moving average is red, meaning price is now back below a falling 30-day moving average. The other three charts, we have our bullish intermediate postures, we have our bullish intermediate confirmation signals, and all three of them are still above their rising 30-day moving averages. And the Dow, by the way, was down 0.65% today. The NASDAQ was down 0.94% today, so it was the worst performer today. And, oh, I take that back, sorry. The Russell 2000 was actually the worst performer. It was down 1.57% today. So of the bullish charts, the NASDAQ was the worst, but if you include the bearish one with the Russell 2000, that was the one that struggled the most. The Dow Jones was the one that was able to withstand the pressure the most here today. And that's oftentimes how things shake out on an ugly day for the market, right? Your blue chips tend to hold up a little bit better. Your more speculative small caps struggle a bit more. So that kind of played out the way that you would assume today. Let's pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. And by the slimmest of margins, we got up and over 100 likes today. In fact, I was a little bit surprised because when I woke up this morning, I think we were only at 90. So some of you really bailed us out in the last moments here today to allow for this hour-long presentation. Otherwise, this video would already be done. So thank you to those that chose to do that and take the 5 seconds out of their day and do something that's completely free that helps support these videos. It is much appreciated and goes a long way with our willingness, our desire, and our motivation to do these videos. Obviously, as busy business owners, we have to truly ask ourselves, dig down deep, if the 3 hours that we're about to spend on making a free YouTube video is worth our time or not. So as long as we continue to get support from our audience, like many of you are committed to doing each and every day, we are more likely than not to continue the videos. If we no longer get support, then of course we might have to make different decisions. But you guys have done a good job with that, and I appreciate it. Let's go ahead and do some shout outs here to those who have liked the video on Tuesday. Thank you to Jeff. Thank you to Nick. Thank you to Keola and Boss and Floyd and Lena and Judy and David and Leah and Teresa and Arthur and John and Sherry and Rich and Claire and Randy and Barry and Common Sense Investing, I think that's Steve, and Michael and Linda and Fun Jonesy, Market Scholars, of course, Alex, Robbie, Jim. Can't get to all of you, but I appreciate y'all nonetheless. Thank you so much for your support. And again, I'll offer the same opportunity for you for the next time I do the video on Tuesday. If we're up and over 100 likes, more than happy to give you a full hour-long presentation, kind of go overboard for you there. On the other hand, if you kind of get sick of these hour-long presentations, that's okay as well. You wouldn't be the first person to say that. And if that's the case, then don't click like. And if we're under 100 likes by the time I'm scheduled to do the video on Tuesday, I'll just plan on making it a short and quick 15-minute one without the 12 grid analysis and the sector selector and the trade application examples. We'll just cut all of that out. So I'll let you guys decide there collectively, but thank you so much to those that supported me the last time around. Also, we had a great day of classes here at Market Scholars, as we oftentimes do. Remember, our main job is to teach our premium members. So some of you might think to yourself, well, don't you just love doing these free YouTube videos? I mean, after all, you're a teacher. Don't you love teaching? And my response is, yeah, I love teaching. Don't get me wrong, but I already had a 3.5-hour class today, so I don't need to do it all over again for free on YouTube. So that's why we ask for your support there. But had a great discussion here earlier today. By the way, a lot of you have seen Schwab transfers take place here over the last weekend. They had another big batch of transfers that took place. There were transfers over earlier weekends this year as well, including Labor Day. So at the beginning of my class today, at the 10-minute mark, I did have a broader discussion about the Schwab Thinkorswim transfer and what it means for people's charts. In some cases, the charts are being transferred over properly. In some cases, they're not. And so I try my best to explain that. Not that I work for Schwab or TD Ameritrade or Thinkorswim. So I'm just a user of their services, just like you guys are, but I'm trying to do my best to explain what I've encountered thus far with that process and what some of the tips and tricks are to kind of get some of you through that process with kind of rebuilding your charts. Remember, as part of your package with David and I here at Market Scholars, if you're a premium member, you get access to all 50 plus of our customized charts. And so many of those charts are being impacted by these transfers that are taking place over to Schwab. It's been a big old headache for a lot of us dealing with these transfers. But it is what it is. We'll get through it. And eventually all accounts will be over at Schwab. But for now, we're kind of in this weird transitory stage, and we're just trying to have to deal with it the best that we can. So if you're interested in that conversation about some of the things that I've learned about the transfer, what to expect for the future if you have yet to go through the transfer, I would encourage you to watch that portion of class. I also got a question about how to handle the decision as to getting into 5% guaranteed type of money like short-term U.S. Treasuries and money market funds, high yield savings and all that kind of stuff versus your traditional dividend growth investing. Also got a question about looking at a company that's really been beat up here lately, Estee Lauder, and whether that has any value to it. That's a company that has a wide economic moat, but has some negative aspects of its business model here at the moment as well. So we took a clean look at that one to look at both some of the pros and cons of that particular stock. We also had a conversation about New Jersey Resources, which is a utility company, obviously in New Jersey, but has a lot of non-regulated assets, so has some interesting side elements to the story that you'll want to be aware of. We also also had a long discussion about McCormick, and we talked about 400 years of history in the spice market, if you can believe it. So in addition to some of their challenges they've been dealing with lately, some of the major acquisitions they've done over time, and where things stand here at the moment with a lot of consumer staples getting roughed up with all the dividend stocks, it feels like, here in 2023, and whether there's an opportunity for those that are thinking long term with a stock like that. So we had those discussions and a lot more in the 3.5 hours I spent with our premium members earlier today. Of course, David had his portfolio management with ETFs trading room that you'll also want to check out. The recordings are available on our trading rooms calendar, as is always the case, assuming you are a premium member. Let's talk about the factor selector tool now. And this gets updated on Tuesday nights, so be aware. It is a couple of days stale by now, but can give us a general idea as to where things stand. Remember, our premium members would have instant access to this, so there is no delay for them. But here on the free video, I tend to have a couple days delay in some of these resources just to make it fair for those of the folks that are part of our premium membership. And remember, later on this month, we'll be having our Black Friday sale. So if you've been wanting to become a premium member of Market Scholars, that will be a great time to do it, to save yourself a few bucks. And remember, another big benefit of that is we let you guys know what our trade applications are for these specific Market Outlook YouTube videos ahead of time if you're a premium member, because we give you access to our private Telegram channel, and therefore you get to learn what the trade ideas, like my Comcast one on Tuesday as just one example. Our members knew about that before the stock market closed on Tuesday, and what my price levels were and what my stop losses were and different things like that. So anyway, we offer a lot of benefits to our 3-year premium package here at Market Scholars, and we would encourage you to check that out. And if you have questions about that, you're always welcome to reach out to us at support@marketscholars.com. Anyway, factor selector tool here. You can see we have a new number 1, and it is the momentum factor. This is the first time in over 3 months that the momentum factor has been the king of the hill. Prior to that, it had always been either quality or a couple of occasions value was up there as well. And that was back when oil prices were doing a lot better. With oil prices stumbling here more recently, value has had a little bit of a tougher time keeping up with it. But momentum still seems to be working. Remember, in this current era, we have a lot of tech stocks that are part of the momentum factor. Momentum is effectively the factor that has the ability to change its stripes the most actively, because it's basically just pushing into what had already been going up. And since this year, we've been talking so much about the Magnificent Seven stocks and other tech-related themes out there like artificial intelligence. It's many of those companies that are part of those momentum funds right now, in addition to a handful of other kind of themes and narratives out there like the weight loss drugs and a handful of other things like that. So anyway, momentum is a more speculative factor, and based upon which was on Tuesday when I did this update, at that time we would have had a 7-day win streak in the market, and so that would have positively impacted a more speculative factor like momentum. Now, in the last couple of days, which included today's sell-off, maybe that's not quite as robust. So, of course, it's important for us to keep our eye on this week after week after week. And, of course, I do my best to share this with you, again, assuming we can get to 100 likes every time I do the video, because this is type of stuff that I would cut out if we only have 15 minutes to do the video. But assuming we're keeping our eyes on this every single week, we shouldn't be completely surprised about what's happening internally within the market. We're going to witness the changes take place before our eyes, and that's an important one that has taken place here recently, that the idea of chasing into those themes that had already been working was accelerated last week when the stock market was in the midst of its 8-day rally. So that supplanted low volatility up there at the top, and quality also fell for its second straight week. In the lower half of the rankings, you'll notice that low size remains dead last. And you'll notice here, if you track this blue ball and chain backwards, low size has either been second to last or dead last every single week for the last 3 months. and you go back and you look at what we were just looking at a second ago with the Russell 2000, that should start clicking in your head that makes sense, right? This is not like some sort of a new story. We've been talking about this for weeks, if not months, about how the Russell 2000 cannot keep up with the other large cap indices. So that's going to play a big role in the low size factor struggling to keep up with many of these other factors that oftentimes are tilted more towards the mega caps or at least the large cap end of the market. All right, let's go ahead and pop back on over here to the paper money account and let's do some 12 grid analysis. Now I'm going to get started here really briefly with chart 5A as we normally do, but then we're going to get into a few other charts for reasons I'll explain here in just a moment. But I didn't want to just completely skip over the asset classes today because it was a big part of the story why the stock market struggled today. In particular, down here in the lower right-hand corner, you'll notice that we have the 10-year U.S. Treasury yield, and it did rally pretty aggressively today, up about 23 basis points. That's a pretty aggressive day. We ended the day at 4.63%. So while it was a big day and we are stabilizing kind of in the same area here over the past week, we do continue to have the strongly bearish posture on it, and the price is obviously still below its moving average, which happens to be rising right now. But it does seem like this move lower has kind of come to an end. It kind of feels like you're now stabilizing at this area right here. And of course, Jerome Powell had some comments today. Some of you saw my tweet, and if you didn't catch it, if you're interested in Jerome Powell's spicy vocabulary, to put it mildly, he was caught with a hot mic moment here earlier today when some protesters had busted in on his presentation, and he had some choice words for them that are not appropriate for me to repeat right now on this presentation, but you can look that up yourself if you want, and I retweeted the video if you want to check that out. But it's good to know that Jerome Powell is not a robot. He's human like the rest of us. He gets frustrated, and he loses his patience on occasion as well. Well, another thing that happened with Jerome Powell today is that he basically came out and said, we're not done fighting this war against inflation. We're no longer close to we're nowhere close to our goal of 2% inflation. We've got a job in front of us, and we intend to continue to do it. And the bond market did not like that. Apparently, there was a bad bond market auction result as well. But whatever you want to point your finger at, it resulted in bond prices going down and bond yields going up, and that generally spooks the stock market, right? We talked about that a bit on Tuesday when I was with you, and I said, hey, the US dollar, oil, and yields were all the pink charts. Today, gold and preferred stocks joined it. But at that time, it was those three, and I was saying how that's generally a good thing. When those three are out of favor, it's giving the green light to the stock market to go up, and that had been the case from kind of a more week-by-week perspective. But on a one-day basis, when you see yields spike, as they did today, you're going to have the offsetting effect more times than not that the stock market is going to sell off. And of course, the bond market did as well. TLT was down over 2% today on the long bond. You also had a big sell-off in foreign bonds and in high-yield bonds as well. All those areas remain with their bullish posture for the moment, since today was really the first day of the selling. But it was a spooky day because it was not just a throwaway day. This was a pretty aggressive sell-off day in the bond market. So we're going to want to keep our eyes on that for sure in the future. Be aware oil did have oversold cluster signals for the third day in a row. Oil was up a touch today, but not up enough to offset the negative pressures from an intermediate perspective that caused those clusters to show up in the first place. US dollar was up today as well. So again, that's not a good thing generally speaking. You're going to have foreign assets selling off, and we did. Emerging markets underperformed the U.S. today. They were down about 1%. Developed stocks actually held up a little bit better. So a little bit of a mixed bag there, but across the board stocks were down. And it's no surprise that, we had the U.S. dollar up and 10-year U.S. Treasury yield up as well, and oil up. So all three of those were up today, and all of them combined together probably put pressure on the stock market itself. I'm now going to turn our attention to a different set of 12 grids than I normally show you. And the reason for that is I just wanted folks to know that I spent several hours last night, as a matter of fact, because a lot of this is very intricate, detailed work that goes into it. It probably doesn't seem like it on the surface, but anytime we're updating these think scripts, it requires quite a bit of discipline in terms of making sure you're not messing up any of the computer programming internally with them. So anyway, last night I did update charts 5E, 5F, 5G, 5H, and then also charts 5K and 5L. Again, notice the dates that are associated with them. So that way you know, if you're a premium member, if you've got the most updated charts or not. So you can see yesterday's date is now on those that I rattled off, November 8th of 2023. So what spurred this on is Ashok, one of our members, had let me know that some of the commodity ETFs were no longer trading because they had some closures on some of those less liquid ETF products. And then also, I think we've all known for quite some time that the Russian stocks have not been trading, and therefore any hopes of getting a Russian ETF back in the mix have kind of gone out the door. So I think initially there was maybe a hope that the Russia-Ukraine thing would get settled, and then the ticker symbol RSX would start trading once again. But we're now well beyond an entire year into that conflict, and there is no activity out there in terms of people hoping to get the Russian stocks back on the market. So we finally succumbed to that, and we replaced Russia, in this case with Australia, on this first global primary 12 grid right here. And for those of you that are wondering, this may have come up in your mind in the past. When we look at chart 5E, which is the global primary 12 grid, and then you see chart 5G, the global secondary 12 grid, you might be wondering, how did we select the specific companies for those two 12 grids? The idea behind it all those years ago when we set it up is we wanted to look at the world's largest economies and have them represented by the ticker symbols that represented their stock markets. And so there is a web page out there that I had used that came from Investopedia. And if you wanted to look it up on your own, it's just investopedia.com/insights/worlds-top-economies. And you can kind of see the rankings off on the left-hand side here as well. They'll take you through some of the stuff here with their write-up. But you can kind of see on the left-hand side here, the U.S. remains, of course, the world's largest economy, then China, then Japan, then Germany, then India, then the United Kingdom, then France, then there's Russia. But the problem is we no longer have a tradable ETF to trade the Russian economy if we wanted to. So we're basically skipping over that. And then there's Canada, Italy, Brazil, Australia, South Korea. So that would be the primary 12 grid there globally. And then the next batch would be Mexico, Spain, Indonesia, Saudi Arabia, Netherlands, Turkey, Switzerland, Poland, Argentina, Sweden, and then eventually I think even like Denmark will show up here. Yeah, so actually it's Norway. Norway shows up there at number 24 as well. So anyway, that's the reason that they're ordered the way that they are, and why we're not including other ETFs that were out there. So for instance, in that secondary 12 grid, we used to have, I think it was Taiwan was in there, but it has now fallen out of that first batch and was replaced by, I think, Poland. So anyway, if you've ever wondered why we have the ones that we selected and why the orders are the way that they are, it's because of the rankings of the world economies. Anyway, as we look at this first 12 grid here, and by the way, this was a lot of the stuff I was talking about earlier today. So if you are somebody that had your Thinkorswim platform transferred over to Schwab over the weekend, you'll probably want to listen to my question and answer session earlier today to see how you are going to be able to import these links into your platform, because your process may be different, unfortunately, than the people who are still at TD Ameritrade using the Thinkorswim platform from there. I've had to basically supply two different sets of links, unfortunately. It creates a lot of duplicative work for me, but it is what it is. Anyway, when we're looking at this first global 12 grid right here, you'll see it's a bit of a mixed bag in terms of bullish charts versus bearish ones. In terms of the area that seems to be doing the best right now in the first set here, I would probably point out Brazil. Right, Brazil catches my eye not because it did particularly well today. It was down with a lot of the rest of the world, down about 0.5%. But you'll notice that Brazil's ETF, in this case EWZ, is up here near a 3-month high. It does have a strongly bullish posture and is now trading above its rising 30-day moving average. So it's had a really big burst of positive energy over the last couple of weeks that's putting it within a stone's throw of multi-month highs. Notice when you look at the country ETFs outside of Brazil that the vast majority of them do not look that way. Most of them probably are just as close to their lows as their highs. So while Brazil is still not above where it was trading here for a few days back in mid-September, that's really the only impediment to that. Whereas a lot of these other charts, you look at something like, I don't know, like the United Kingdom right here or France in the middle. Notice that those two are still stuck in obvious downtrends, right? Yeah, you've had a little bit of positivity out of France here more recently where it's making an attempt, but for the most part, where we're trading on France is still closer to the 3-month lows than it is the 3-month highs. Whereas for Brazil, it's not that way. Here we're closer to the 3-month highs than we are the 3-month lows. So if there's a baton pass that's taking place globally right now, Brazil seems to be one of the beneficiaries of that move here more recently. Let's take a look at the next chart. I don't use these comparison charts as much as David does, but remember that each 12 grid has an associated comparison chart associated with it. And in this case, the global primary comparison, 5F. Let's go ahead and pull that up. That's one of them I updated here last night as well. So here it gives us kind of a slightly different view where India has done the best over the last 3 months. Now Brazil is in second place, and Brazil is important because of what it's done in just the last 2 weeks. But if you go back a little bit further in time, India also has some strength there. It's just that India is much more off of their highs that they achieved back here around September 11th. Now on to the secondary global 12 grid, and this is chart 5G. Here you can see you have a few more green charts on the board, and in this case I would say that the leading country would probably be Poland. Notice in the lower left-hand corner here, Poland has its intermediate reading at 93, which is the best of this group, and it is the closest to its 3-month highs, whereas again you have a lot of others, like the one right next to it, Argentina, you still are closer to the lows than the highs over the last 3 months. So I would say that if you're looking for bullishness internationally, 2 international markets to keep on your radar would be Brazil and Poland. In the case of Poland, its ticker symbol is EPOL. And then same thing, there's an associated comparison chart that goes with it, and that will be chart 5H. And in this case, you can see that Poland is up here in second place, somewhat similar to what I'd mentioned about Brazil. Technically, Turkey is above it right now, but notice how far off the top Turkey is. I mean, Turkey has given back a huge amount of their gains, whereas Poland was once the worst, it's this pink line down here, and is now second best. So there's a lot more recent momentum pushing into Poland right now and pushing out of Turkey. So there's kind of like 2 ships crossing in the night right there. And then another 12 grid that I updated last night was chart 5K, and this is the commodities 12 grid. In this case, several of the commodity ETFs we previously were using have basically folded up because there was not enough interest apparently of people trading them. Remember, commodities are a little different because most people that want to trade commodities are going to trade the futures contracts themselves. They don't need to trade an ETF, which is a derivative of that, if they've got a perfectly acceptable liquid alternative in terms of futures contracts. So there is a little bit more challenges, and plus you have to do the futures rolls and all this kind of stuff that kind of limits some of the the commodity ETF creation as well. So anyway, it's this chart in the middle rung off to the right that needed to get changed. It used to be JJC. I've now updated that to CPER as the new copper ETF. And then it's these three charts in the lower right-hand corner on the bottom rung that needed to get updated as well. Sugar used to be SGG. I've changed that to the new one, cane. But the other two I couldn't get an active replacement with because there really wasn't any out there. The other two I believe were cocoa and coffee. And there, from what I can tell, I did some research on this. I don't think that there is a alternative, at least for us here in the United States, for the commodity of coffee and the commodity of cocoa any longer the way that there used to be. So I had to change those out entirely, and we are now looking at wheat and soybeans instead. So the idea behind this 12 grid is still kind of the same, where you've got your energy-related commodities up at the top, oil, natural gas, gasoline. You've got your metals in the middle rung with gold, silver, platinum, copper, and then on the bottom rung is what you would call the soft commodities, corn, wheat, soybeans, and sugar. And when you're looking at this, it seems like it's the soft commodities that have the bullishness right now. In particular, sugar looks pretty strong compared to the rest of them. Okay, and then of course there is an associated comparison chart on that one as well, which is chart 5L. And here you can see sugar really rocking it to the upside, kind of separating itself from the rest of the commodity pack right now. All right, let's now get into our trade application example. And I'm just going to pull up our swing trading 1 grid here, which is chart 3A. You'll notice, by the way, that the S&P 500 has now gone to a bearish posture on the near-term line. So even though the intermediate line is still bullish, the blue near-term line, which is a more sensitive line, has now gone to bearish. Now, remember, because it's more sensitive, you're going to have a lot more transitions take place from bearish to bullish. So you have to acknowledge that as well. But this is the chart that I use most often for our swing trading ideas, including that chart that I showed you for Comcast here a couple of days ago, right? This was the chart that I was showing you. At that time, it was rolling down from that falling moving average, and it did continue to sell off the next 2 days. Even yesterday, when the rest of the market was up, it was down, and then today it sold off yet again. And I felt kind of lucky with that one, by the way, as well, because last night, before I went to bed, I saw a headline hit my phone that the writer's strike had been resolved, and I'm like, oh, great, I got a bearish trade on a media company, because remember, Comcast owns NBC. And so I was thinking that today it might actually shoot higher on me. And it's kind of lucky, I think, that that news hit when the stock market wasn't open, because I might have been somewhat tempted to pull the trade off early had I seen that while the market was open. Luckily, cooler heads prevailed. I let the trade breathe, and we achieved our 100% max gain price target on it here today after being in the trade for just 2 days, right? Usually I call being in the trade for 1 day hitting the easy button. Today wasn't 1 day, but it's still, you like to see it when you're in and out in just 2 days there. So that one worked out nicely. The one I wanted to share with you here today, and again, this trade is already done. I've already sent out the details to our premium members on our private channel when the stock market was still open. And this is Old Dominion Freight. So this is a trucking related company, of course, in the industrial sector and within the transportation subsector. And you'll notice here it's kind of got some of the same vibes as the Comcast chart that I had shown you previously. On this one, I did use the options market. Not necessarily because it was more liquid, because quite frankly, it was not more liquid than Comcast. Comcast is going to be more liquid with the options market than ODFL. But the reason is more because this is a high price security. And most of you know that with this generic video here where we don't have trading plans that are associated with it the way that I have for all of my premium trading rooms that I teach during the week, where we have very precise position sizing and everything. Here I just use the default. So when I'm trading stock, if we're buying it, we're buying 100 shares. If we're selling selling it, we're selling 100 shares. And if we're doing an options contract, we're just doing one contract. So we don't put a whole lot of effort into position sizing, at least I don't on these market outlook videos, the way that I do for my premium members in our trading rooms. So for that reason, I was a little bit more tempted to do a options trade on this as opposed to short selling a stock that is trading for almost $400 per share, when I would normally have my kind of default trade being equal to 100 shares, right? That's a pretty big position size there. So I opted to go in this case with doing a bear call spread. So obviously that's a bearish trade. And what we're doing in a bear call spread is we are selling one call contract and at the same time buying another call contract to create a credit, because the strike that you're selling is more expensive than the strike that you are buying. And therefore, if you're selling something that's more expensive and buying something else that's less expensive, it creates a credit that you receive up front. And that is kind of your reward for doing the trade. And it's your job then to hang on to as much of that reward as possible. And the way that you do that is by keeping the stock in question, or the ETF, whatever you're trading, underneath your break even for the trade. So what I did in this case with ODFL was I used the December contracts and I sold the 410 call and I bought the 420 call. That created a credit of $2.35. So you add that credit of $2.35 to your sold strike of 410 to create this number of 412.35. That is our break even. So I tried to draw it there with that thick black line, so that way it's easy for you all to see. And so that way you can, think about it for yourself as to whether you think that is an adequate amount of safety or not for this trade, right? Because we'll never know. None of us have a crystal ball or know the future. But that is where kind of our line in the sand is with this. If ODFL, which is trading right now at $385, stays below $412 between now and the December expiration, which is the third Friday of the month, then this will be a winning trade. On the other hand, if ODFL rockets higher due to an end of the year Santa Claus rally or any other reason, then our trade will likely lose money. But the good news is, unlike the trade that I did with Comcast, which was a simple short selling idea, remember when you're short selling stock, you don't know what your worst case scenario is, because a stock does not have a ceiling price. It can go up forever. Now, of course, I set up that Comcast trade with a bracket order, so I wasn't going to assume that type of risk, but theoretically, there is unlimited risk when you are short selling a stock. The nice thing about when you are selling a bear call spread is you have defined risk. You know what your worst case scenario is the moment you place the trade. And so if this stock, for whatever reason, rocketed up to $500 per share, maybe another trucking company comes in and says, we want to buy you out, whatever the reason, if it were to rocket beyond where I want it to go, above this black line here, I will lose money in the trade, but I won't continue to lose more and more money the higher it goes, the way that you would if you were just short selling the stock itself. So that's kind of the nice benefit there as well. But it's a pretty obvious setup, right? We've already had our earnings. The stock was in a downtrend before earnings. The earnings kind of resulted in a reversion to the mean type of a move. You did have one oversold cluster during that time period, but when it reverted to the mean, like so many of them, stalled out right there at the obvious point of using that downward trending 30-day moving average as resistance for the last 3 days. You can see the background color of the chart is pink, telling us that we have a bearish near-term posture. You also have a bearish intermediate posture. The green line, while you can barely see it right here, you can read it in the label, is at 47 and falling. So that kind of supports this decision for swing trading purposes. Plus you have a bit of a bearish near-term divergence feel associated with this trade setup. Notice that you had a high point in the blue near-term line right here on November 1st. You had a follow-up high point right here on November 6th. That follow-up high point was lower than the original high point, yet on the price candles itself, it was this candle and this candle. So price went up at a time when there was a slight deterioration on the underlying indicator right there. So for that reason, decided to put on another bearish trade here again, especially since our Comcast trade is no longer working for us, right? Because one of the things I had mentioned to you guys on Tuesday is that the only other bearish trade I had in the portfolio was the Abbott Labs trade, which is still on right now. And then I thought I was adding another bearish trade with Comcast. Well, good news, bad news there. The bad news is no longer in our portfolio. The good news, of course, is because it went to max gain, but it no longer has the bearish deltas in our portfolio. So now I've got another opportunity to add those bearish deltas if I want it with Old Dominion to kind of offset some of the bullish trades that we still have going in the portfolio as well. Okay, so that is the trade application example, along with a lot of additional 12 grid analysis here tonight on global markets. Remember, Poland, Brazil looking pretty strong. And then from a commodities perspective, keep your eye on sugar. So if you enjoyed that presentation, if you got value out of the time you've spent with me here tonight, I ask one simple thing out of you, and each one of you has the ability to do it. It's just a matter of whether you're willing to do it. Most of you are, or I should say many of you are. Technically, most of you are actually not willing to do it, because a lot of times we have hundreds of people that watch this video, and it's like twisting arms to get even 100 people to click like. But those of you who do are amongst our most loyal and supportive, and we really do appreciate you. So if you wouldn't mind taking 5 seconds out of your day to click a free button for us, it would be quite helpful for us. If we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll give you another hour-long presentation. On the other hand, if you prefer the shorter 15-minute videos, then don't click like, and we can certainly go that route as well. So we'll leave that in your guys' collective hands. Whatever you decide, I appreciate you checking out tonight's video. I'll wish you all the best of success with your trades and your investments. Goodbye for now.